All right, everyone, let's dive into this important case study. Imagine we have a company called Mars and Company. They are planning to issue a prospectus to attract investors by showing them what the company expects to achieve in the future. Now, Mars and Company has hired you to examine these projected financial statements and provide a report. The core question here is, what are your specific duties when examining this prospective financial information? To answer this in your exam, you must first anchor your answer by mentioning the specific standard. You should state that as per SAE 3400, which deals with the examination of prospective financial information, the auditor's primary goal is to obtain sufficient and appropriate evidence.
First, look at the assumptions. You need to verify if the best estimate assumptions used by the management are not unreasonable. Furthermore, if the company has used hypothetical assumptions, you must ensure those assumptions are consistent with the overall purpose of the information being provided. Second, focus on the preparation. You must check whether the prospective financial information has been properly prepared based on those assumptions. It is not enough for the assumptions to be reasonable. The math and the logic used to build the projections must be accurate.
Third, check the presentation and disclosure. You need to ensure the information is presented properly and that all material assumptions are adequately disclosed. Crucially, the report must clearly indicate whether the assumptions used are best estimate assumptions or hypothetical ones. This transparency is vital for the investors. Finally, ensure consistency. You must verify that the prospective financial information is prepared on a consistent basis with the historical financial statements, using the appropriate accounting principles. You cannot change the accounting rules just to make the future look better.
If you structure your answer using these 4 points, assumptions, preparation, presentation, and consistency, you will provide a comprehensive response that examiners love. Keep this structure in mind and you'll nail this topic.
Imagine a student, let's call her Mars, who believes that cyber risks are strictly IT issues that only lead to information loss. She further argues that if a cyber attack doesn't target financial systems directly, it doesn't pose a risk of material misstatement to the financial statements. Now, as future auditors, we need to be very clear. This view is absolutely not proper. When you write this in your exam, start with a clear, direct statement. Her view is not proper. Then explain the logic. Cyber risks are not just an IT problem. They are fundamental business risks that impact the entire organization, including its reputation.
To score full marks, you must list the consequences of cyber risks. I want you to remember these 8 points. First, there are regulatory costs. Second, business interruptions that create operational challenges. Third, we have data loss, reputational damage, and potential litigation. Fourth, the threat of ransomware. Fifth, the theft of intellectual property, which is crucial because it can lead to impairment or impediment charges in the books. Sixth, the incident response costs required for investigations and remediation. Seventh, the breach of privacy and its overall impact on the organization. And eighth, the heavy fines and penalties that follow.
Now, let's address the second part of the argument. Even if an attack isn't aimed directly at the financial systems, it's a huge red flag. Why? Because once an attacker gains access to the network, they can potentially manipulate or modify financial records, change key automated business rules, or override the automated controls that management relies on.
Therefore, the conclusion for your answer should be that an auditor must consider whether cyber risk represents a risk of material misstatement as part of the overall audit risk assessment. The focus must be on understanding the specific cyber risks affecting the entity and evaluating the actions being taken to address those risks. Keep this structure in mind, and you'll nail this question.
All right, everyone, let's dive into this critical case study regarding professional ethics. Pay close attention to how we structure this answer, as this is exactly how you should present it in your exams to score maximum marks.
First, let's look at the scenario. We have a company and a superannuation pension fund managed by a trust. Both are under the same management. Now, the auditor who is auditing both the company and the trust finds some irregularities. He does something very common but risky. He mentions these issues in a confidential report to the trustees, but he stays silent in the main audit report on the annual accounts of the trust. The question is this a violation of the Chartered Accountants Act?
To answer this, we must start with the legal provision. This is the core of your answer. You need to refer to the disclosure of material facts. Specifically, a chartered accountant in practice is deemed to be guilty of professional misconduct under Clause 5 of Part I of the Second Schedule if he fails to disclose a material fact known to him, which is not disclosed in a financial statement, but the disclosure of which is necessary to make the financial statement not misleading.
Now, let's apply this law to the facts of our case. In this situation, the auditor was fully aware of the contraventions and irregularities because he had already documented them in his confidential report to the trustees. Despite this knowledge, he issued the annual accounts without any qualification or mention of these issues. To strengthen your answer, you should mention the judicial precedent. On similar facts, the Supreme Court in the case of Neon versus Mars held that it was the absolute duty of the chartered accountant to disclose such irregularities and contraventions to the beneficiaries of the fund within the statement of accounts he signed.
So, to conclude, in the present case, the auditor's action of hiding these facts in the main report while mentioning them only in a private letter is a breach of professional ethics. Therefore, it must be held that the chartered accountant is guilty of professional misconduct, provided that the amount of the irregularities is proved to be material. Remember, the key takeaway here is that a confidential report is not a substitute for a qualified audit report when the facts are material. Keep this structure in mind. Provision, application, case law, and conclusion. You've got this.
All right, let's dive into this important scenario. Imagine we have a company called Mercury, which has entered into a contract with Venus. Under this contract, Mercury needs to have its financial statements reviewed on a quarterly basis. Now, as the practitioner, you are stepping in to conduct this review. The core question here is, what factors should you consider before accepting or continuing this client relationship and the review engagement? To answer this in your exam, you must refer to SRE 2400.
First, you must ensure there is a rational purpose for the engagement. Think of this as the why of the assignment. You can't accept the job if the purpose isn't logical. For example, if there is a massive limitation on the scope of work, or if you suspect your name is being used inappropriately, there's no rational purpose. Also, if the law specifically requires a full audit, then a simple review engagement doesn't make sense. Second, you need to decide if a review engagement is actually appropriate for the circumstances. During your preliminary understanding, if you feel a review isn't enough, you can suggest a different path.
Third, consider the ethical requirements. This is a non-negotiable. If you have reason to believe that ethical standards, especially independence, cannot be satisfied, you must decline the engagement. Fourth, look at the availability and reliability of information. If your initial assessment suggests that the data needed to perform the review will be unavailable or simply unreliable, you cannot proceed.
And finally, evaluate the integrity of management. If you have any reason to doubt the honesty or integrity of the management team, and you believe this doubt will affect the proper performance of the review, you should not accept the engagement. Similarly, if management or those charged with governance impose a scope limitation that is so severe that you believe you'll end up disclaiming your conclusion, then the engagement is not viable.
Keep this five-point structure in mind: rational purpose, appropriateness, ethics and independence, reliability of information, and management integrity. If you present your answer using these clear headings, you'll be hitting all the marks the examiner is looking for. You've got this.
All right, let's dive into this critical case study. This is a classic exam scenario focusing on the boundaries of professional suspension under the Chartered Accountants Act. Pay close attention to how we structure this answer, as the examiners look for a specific flow: the law, the interpretation, and then the final conclusion. First, let's look at the scenario. We have a member, let's call him Mars. Mars was ordered to surrender his certificate of practice and was suspended for 2 years because he failed to check the requirements of sections 139, 140, and 140, one of the Companies Act, before accepting an audit. Now, while suspended, Mars started working as a data privacy consultant, filing returns and appearing before authorities in that specific capacity, not as a chartered accountant. He argues that since he's acting as a general consultant, he isn't violating his suspension.
Now, how do we tackle this in the exam? Start your answer by citing Section 6 of the Chartered Accountants Act, 1949. This is your foundation. Section 6 clearly states 3 main points. First, no member of the Institute is entitled to practice, whether in India or anywhere else, unless they hold a valid certificate of practice from the Council. Second, every member must pay the annual fee determined by the council. And third, the council has the power to cancel this certificate under prescribed circumstances.
Now, here is the deep dive analysis part where you earn your marks. You must explain that once a person becomes a member of the Institute, they are bound by the Act and its regulations. For example, if a member appears before an income tax tribunal, they do so in their capacity as a chartered accountant. They cannot simply ignore the jurisdiction of the Act by claiming they are practicing in a different capacity, if that capacity is essentially the same professional service.
However, we must apply this logic to the specific facts of our case. Mars is not pretending to be a chartered accountant. He has specifically designated himself as a data privacy consultant. He is performing work related to data privacy returns and appearing before authorities as a consultant in a capacity entirely different from a chartered accountant in practice. Therefore, the final conclusion is straightforward. Since Mars is not appearing or practicing in the capacity of a chartered accountant, he is not violating the suspension order. To wrap this up for your exam, state the law under Section 6, explain the principle of jurisdiction, apply it to the fact that he is acting as a data privacy consultant, and conclude that there is no violation.
All right, let's dive into this important case study. Imagine we have a company called Planet X now. Planet X has appointed Mr. Neon, an expert, to handle the actuarial calculations for insurance contracts and employee benefit plans. These complex numbers are then used by the management to prepare the financial statements. Our goal here is to guide Mr. Argon, the statutory auditor, on how to handle this situation. First, let's look at the core requirement. When an auditor uses information prepared by a management's expert as audit evidence, Standard on Auditing 500, which deals with audit evidence, tells us that the auditor must take 3 critical steps.
Step 1, the auditor must evaluate the competence, capabilities, and objectivity of that expert. In simple terms, Mr. Argon needs to ask, is Mr. Neon actually qualified? Does he have the right skills? And is he unbiased? Step 2, the auditor needs to obtain an understanding of the work performed by that expert. You can't just take the final number. You need to understand how Mr. Neon arrived at that figure. And step 3, the auditor must evaluate the appropriateness of the expert's work as audit evidence for the relevant assertion. Basically, does this work actually prove what the management is claiming in the financial statements?
Now, the second part of the question asks about the factors that impact the nature, timing, and extent of the audit procedures. This is a list of considerations that will determine how much work Mr. Argon actually needs to do. Let's break these down. First, consider the nature and complexity of the matter. If the actuarial calculations are incredibly complex, the auditor will need to do more detailed work. Second, look at the risks of material misstatement. If there is a high risk that these numbers are wrong, the audit procedures must be more rigorous. Third, check for the availability of alternative sources of audit evidence. If Mr. Argon can verify the numbers from another source, he might rely less on the expert. Fourth, consider the nature, scope, and objectives of the expert's work. What exactly was Mr. Neon asked to do?
Fifth, is the expert an employee of Planet X or an external party engaged for services? An external expert might be seen as more objective. Sixth, how much control or influence does the management of Planet X have over the expert's work? If management is pushing the expert to reach a certain number, that's a red flag. Seventh, is the expert subject to technical performance standards or industry requirements? If Mr. Neon follows a strict professional code, it adds a layer of reliability. And finally, the nature and extent of any internal controls within Planet X over the expert's work. If the company has a strong review process for the expert's reports, the auditor can feel more confident.
All right, let's dive into this important case study. Imagine you are the expert auditor here. Mars wants to acquire a specific business unit from Venus. However, Mars is a bit hesitant because they aren't sure if this unit will actually be viable or profitable in the long run. You have been brought in to investigate the economic and financial health of this unit.
Now, when you're writing this in your exam, you must maintain a structured approach. To evaluate the economic and financial position, you need to focus on these four critical pillars.
First, look at capital adequacy. You need to ask yourself, is the fixed capital and the working capital sufficient? You aren't just looking at the current balance, but whether these funds are adequate to support the future growth of the business. If the capital is lacking, the business cannot expand. Second, analyze the trends. You cannot look at a single year's data. You must establish the trend of sales and profits for the future. To do this effectively, break it down product-wise and area-wise. By analyzing which products are selling and in which regions they are performing, you can conclude if the current growth trend is sustainable.
Third, evaluate the return on investment. It is not enough to just make a profit. You have to determine if the expected future profits will yield an adequate return on the total capital employed. In simple terms, is the profit worth the investment being made by Mars? And finally, assess the capacity utilization. Check if the business is currently operating at 100% capacity. If it isn't, there is a huge opportunity here. You need to identify if improvements can be made to reach full productivity, which could potentially increase the value of the acquisition. Keep these 4 points clear and distinct in your answer, and you will nail this question.
First, let's set the scene. We have Mercury, who is the statutory auditor of Oxygen Limited. Oxygen has a subsidiary called Venus Private Limited. Now, the auditor of the subsidiary, Mars, has issued a qualification in the CARO report, stating that short-term funds were used for long-term purposes. Mercury wants to include this qualification in the consolidated audit report, but the management of Oxygen is pushing back, claiming it's not necessary.
Section 1. The provision of paragraph 2 of CARO 2020. You must state clearly that generally, CARO provisions do not apply to the auditor's report on consolidated financial statements. However, there is one very important exception, and that is Clause 21 of paragraph 3.
Section 2. Explaining Clause 21 of Paragraph 3. This is the heart of the matter. This specific clause mandates that the auditor must comment on whether there are any qualifications or adverse remarks in the CARO reports of the companies included in the consolidated financial statements. If such remarks exist, the auditor isn't just mentioning them. They must provide the specific details of the companies and the exact paragraph numbers of the CARO report where those qualifications appear.
Section 3. Applying this to Mercury's responsibility. Based on these rules, Mercury has three specific duties. First, they must report under Clause 21 of Paragraph 3 regarding any qualifications in the group companies. Second, they must specifically incorporate the qualification made by Mars regarding the misuse of short-term funds in Venus Private Limited. And third, they must explicitly mention the paragraph number from Mars's report.
Finally, Section 4. Addressing the management's contention. You need to conclude firmly. The argument made by the management of Oxygen is simply not valid. Under the provisions of CARO 2020, Mercury is legally obligated to report these qualifications. In conclusion, for your exam, remember that while CARO generally doesn't apply to consolidated reports, Clause 21 is the golden exception.
First, let's look at the scenario. We have a company, let's call it Mars, which is facing a crisis over its Greenstream smartphone. Now, the company was shouting loud and clear about Principle 9, focusing on customer well-being and safe usage. But when the audit of the Business Responsibility and Sustainability Report, or BRSR, happened, a much darker reality emerged. While Mars was great at handling customer complaints, they completely ignored the fact that their subcontractors in the mineral supply chain were using coercive labor. To make matters worse, a regulatory officer was allegedly bribed to look the other way. The board of directors has now stepped in, stating that their governing structure must proactively respond to any entity in their entire ecosystem that violates the 9 principles, whether they are a supplier or a distributor.
Now, as a CA finalist, you need to identify the specific principle that Mars must implement to fix these ethical and structural failures. The answer is Principle 1, which covers ethics, transparency, and accountability. Now, here is how you should structure this in your exam to score full marks. Start by acknowledging the distractions. Yes, the Greenstream phone involves product sustainability, which is Principle 2, and consumer well-being, which is Principle 9. However, the core failure here isn't the product itself. It is a failure of governance and accountability.
To elaborate further, Principle 1 emphasizes that business decisions in an organization must be open to disclosure and accessible to all relevant interested parties. You should list these 5 core elements clearly in your answer. First, the entity's governing structure must develop strict policies, procedures, and practices for all offices, factories, and work areas to ensure that ethics are never compromised. Second, all information regarding these policies, procedures, and the actual performance must be made available to the stakeholders. Third, if there are adverse effects, the company must take extra care to ensure transparent disclosures.
Fourth, the governing structure should actively encourage every entity within its value chain to adopt these principles. And finally, the entity must proactively respond to any outside entities that violate the 9 principles of the BRSR. This specifically includes their suppliers, distributors, subcontractors, or any regulatory officers engaging with the business. Keep this structure in mind. Identify the principle, explain why other principles are secondary, and then list the core elements of Principle 1. You've got this.
All right, let's dive into this case study. Imagine you are in the shoes of Mars, a CA final student who has been assigned to the statutory audit team of the Neon Finance Corporation. Now, Neon is a major public sector undertaking, which means the stakes are high. Mars is dealing with some heavy-duty issues here. Complex consolidation with subsidiaries, extreme share price volatility, and a formal notice from the regulatory body, Saturn. The audit team is even considering adding an emphasis of matter paragraph to the report to keep things transparent. The core of the question asks us to identify the potential sources Mars should use to gain a comprehensive understanding of this entity.
First, look at the internal documents of the entity. Mars should examine administration and function files, policy documents, annual reports, budgets, and accounts. Don't forget the minutes of meetings, website information, internal audit reports, electronic databases, MIS reports, and even RTI material. These are your primary internal clues.
Second, since this is a public sector undertaking, legislative documents are vital. This includes actual legislation, parliamentary questions and debates, and reports from the Public Accounts Committee, the Committee on Public Undertakings, and the Estimates Committee, as well as letters from members of Parliament.
Third, we move to policy documents. Mars needs to review documents from the Planning Commission and the Ministry of Finance to understand the broader strategic direction. Fourth, consider academic or special research. This involves looking at independent evaluations of the entity, academic research, and similar work conducted by other governments or supreme audit institutions.
Fifth, always look at past audits. Previous financial and performance audits are a goldmine of information and provide a historical context of the entity's health. Sixth, keep an eye on media coverage. Both print and electronic media provide a systematic and transparent view of how the entity is perceived publicly. And finally, engage with special focus groups. This means reviewing concerns from the Audit Advisory Committee, annual and special reports from the World Bank or the Reserve Bank of India, and reports by NGOs or special interest groups.
Imagine we are auditing a company called Planet Limited, and our auditor, Element R, has spotted a major red flag. There is a massive trade receivable of 2 crore rupees that hasn't been written off, even though the party involved has fled the country and is absconding. Element R has the evidence that this money is gone and cannot be recovered. However, the management is refusing to fix this misstatement. Now, here is the kicker. The company is reporting a profit before tax of 1 crore, but the materiality threshold is set at 5% of that profit.
First, start with the theoretical foundation. Refer to Standard on Auditing 705. State clearly that an auditor must modify their opinion in two scenarios. 1. When the auditor concludes that the financial statements are not free from material misstatement, or 2. When the auditor simply cannot obtain enough evidence to conclude they are free from misstatement. Next, apply this to our specific case. In this scenario, Element R has already obtained sufficient evidence regarding the non-recoverability of that debt. So, we are dealing with a known misstatement.
Let's do the math for the examiner. The uncorrected misstatement is 2 crores, while the profit is only 1 crore. That means the misstatement is 200% of the profit before tax. Since our materiality limit is only 5%, this is undeniably material. But is it pervasive? Yes. Why? Because if we write off this 2 crore debt, the company doesn't just have a smaller profit, it swings from a profit of 1 crore to a significant loss. This, fundamentally, changes the financial picture of the company.
To wrap up your answer, conclude firmly. Because the misstatement is both material and pervasive, Element R must express an adverse opinion in accordance with the requirements of SA 705. Keep this logic flow, theory, application, calculation, and conclusion, and you'll nail this question.
All right, let's dive into this critical case study on SA 710, which deals with comparative information. This is a classic exam scenario where you need to understand how a qualification from a previous year's audit report carries forward or is resolved in the current year.
First, let's look at the scenario. We have a company called Planet Neptune. They hold a portfolio of equity securities, but the market value has dropped. In the previous financial year, ended March 31st, 2023, the auditor issued a qualified report because the company failed to provide 70 lakh rupees for this diminution in value. Now, we are the auditors for the year 2023-24, and we need to decide how to report in two different situations.
Situation 1. What if the company still does not make a provision for the diminution in value in the year 2023-24? In this case, the matter is still unresolved. According to SA 710, if the matter that caused the qualification in the previous period remains unresolved, the auditor should modify the opinion in the current period's report. Since the non-provision of 70 lakh rupees is still affecting the financial statements, you must continue to qualify your opinion.
Now, let's move to situation 2. What if the company finally makes an adequate provision for the diminution in the year 2023-24? This is a different ballgame. Here, the issue has been resolved. The company has now corrected the error by making the necessary provision. According to SA 710, if the matter that caused the qualification in the previous period has been resolved, the auditor does not need to qualify the current year's report. You can issue an unmodified opinion. However, you don't just ignore the past. You should mention in your report that the matter which was qualified in the previous year's report has now been adequately addressed.
To summarize for your exam, if the error persists, keep the qualification. If the error is corrected, give a clean opinion but acknowledge the resolution of the previous qualification. Keep this logic clear, and you'll ace this topic.
All right, let's dive into this critical case study. Imagine you are the engagement partner for the audit of Neon Petrochemicals Limited for the financial year 2025-26. Here is the situation. The company has expanded into a high-risk ecological zone. Now, the management is trying to tell you that because they have a general policy of being ethical, they don't need specific documented protocols for environmental law compliance.
As an auditor, you need to see through this. Your team has found 3 major red flags. First, there are no formal records of the environmental statutes for this new zone. Second, while there is a code of ethics on the website, the actual workers on the ground have never been briefed on it. And third, a whistleblower has alleged that waste disposal norms are being ignored just to save costs.
Now, when you write this in your exam, you must evaluate the management's contention. Is a general ethical policy sufficient? Absolutely not. To answer this, you need to outline the specific framework of policies and procedures that Neon Petrochemicals should have implemented to prevent and detect noncompliance.
Follow this structure exactly to score maximum marks. First, the entity must focus on monitoring legal requirements. They need to ensure that their operating procedures are specifically designed to meet these laws, which directly addresses the lack of records for that new ecological zone. Second, they must institute and operate appropriate systems of internal control. You cannot rely on a vague sense of ethics. You need hard controls. Third, it is not enough to just have a code of conduct on a website. They must develop, publicize, and actually follow a code of conduct. Fourth, and this is a key point for your answer, they must ensure employees are properly trained and actually understand the code.
Fifth, there must be a mechanism for monitoring compliance with this code and a clear process to discipline employees who fail to comply. Sixth, the company should engage professional legal advisors to help them monitor these complex legal requirements. And finally, they must maintain a formal register of all significant laws and regulations applicable to their industry, along with a record of complaints. This is the direct solution to the whistleblower allegations.
By highlighting these specific missing pieces, you demonstrate to the examiner that you understand how a lack of formal procedures impairs the audit's integrity and increases the risk of material misstatement due to noncompliance. Keep this structured approach, and you'll nail this question.
All right, let's dive into this critical case study. Imagine you are the auditor for Mars Limited. You've sent out positive confirmation requests to 45 creditors in March 2024. Now, these creditors are small concerns in the informal sector. You did everything by the book, discussed it with the CFO, and sent the requests to the addresses listed on the bills. The CFO was perfectly cooperative, and surprisingly, you got all your responses back within just 1 week. But here is where the plot thickens. Your articled clerk does some digging on the GST portal and finds a massive red flag. Out of those 45 creditors, 38 of them had their GST registrations canceled during the financial year 2023-24. Even more concerning, there are no new registrations linked to the PANs of these parties.
Now, think about this logically. If the GSD registrations were canceled, it strongly suggests these businesses were closed. So, if the businesses are closed, who exactly responded to your confirmation requests in March 2024? This immediately puts a giant question mark over the reliability of those responses. To answer this in your exam, you must structure your response using two key standards on auditing. First, refer to SA 505, External Confirmations. You need to state that if an auditor determines a response is not reliable, they must evaluate the implications on the assessment of material misstatement, specifically the risk of fraud.
In this case, the fact that 38 businesses were likely closed, yet responded to the letters, means the responses are highly unreliable. Second, bring in SA 500 audit evidence. Explain that even evidence from external sources can be unreliable. Mention that all responses carry a risk of interception, alteration, or fraud. Specifically, point out that a response is doubtful if it appears not to have come from the originally intended confirming party.
To wrap up your answer, conclude that in this scenario, there is a significant risk that the responses did not come from the actual creditors. This is a major fraud risk factor that you, as the auditor, must now evaluate and investigate further. Keep this structure, standard, application, and conclusion, and you'll nail this question.
First, let's look at the scenario. We have a company, let's call it Mercury, which manufactures spare parts. Their auditors, Neon and Associates, have spotted a major red flag. Mercury had a huge customer, let's call them Mars, based in South Korea. Due to an outbreak of war and government bans on trade, the demand from Mars has completely stopped. Now the management tells the auditor, Neon, that they are looking for new customers, but they haven't found any yet. The key takeaway here is that while the company is still operating, there is a material uncertainty regarding their ability to find new clients, which could threaten their survival. Crucially, the management has already disclosed this fact in the financial statements.
Start with the legal framework. State that as per standard on Auditing 570, going concern, the loss of a major market or a key customer is a clear operating indicator that may cast significant doubt on a company's ability to continue as a going concern. Next, apply this to the facts of the case. Mention that Mercury has lost its key customer, Mars, due to the war and trade bans in South Korea. Since they are still in the process of identifying new customers, this creates a material uncertainty that casts significant doubt on their ability to continue.
Now here is the turning point for your answer. Note that the management has already disclosed this uncertainty in the financial statements. Because the disclosure is adequate and the going concern assumption is still appropriate, the auditor does not need to qualify the report. So the final conclusion and the action for Neon should be presented in two clear points. First, the auditor should express an unmodified opinion. This means the financial statements are still fair. Second, the auditor must include a separate section in the audit report under the specific heading, Material Uncertainty Related to Going Concern.
In this section, the auditor must do two things. 1. Draw attention to the specific note in the financial statements where the management disclosed the issue. And 2. Explicitly state that these conditions indicate a material uncertainty exists, but emphasize that the auditor's opinion is not modified in respect of this matter. And that is how you wrap it up. By following this flow, standard, application, and then the specific reporting requirement, you ensure you cover every technical requirement the examiner is looking for.
All right, everyone, let's dive into this critical case study. We are looking at a scenario where an audit firm, let's call them Mars and Associates, is being approached by a company called Neon Limited. Now, this is a classic exam-style question focusing on the quality control procedures regarding the acceptance of a new client. Specifically, we need to analyze the integrity of Neon. When you write this in your exam, I want you to follow the structure of the provided answer exactly, as it mirrors the professional standards. You need to evaluate the integrity of the client based on these 7 key pillars.
First, consider the identity and business reputation of the principal owners, key management, and those charged with governance. In our case, we have red flags here. We have rumors of investigations into foreign transactions and a history of regulatory violations linked to a previous venture. This is a major warning sign. Second, look at the nature of the client's operations and their business practices. Neon is in the volatile cryptocurrency trading space, which inherently carries higher risk.
Third, examine the attitude of the management toward accounting standards and internal controls. The case explicitly mentions a reputation for aggressive accounting interpretations. This tells us the management might try to manipulate the numbers to look better than they are. Fourth, check if the client is obsessively focused on keeping professional fees as low as possible. The prompt mentions relentless pressure to reduce fees. Why does this matter? Because when a client squeezes the auditor's fee, it often leads to a compromise in audit quality or pressure to cut corners.
Fifth, look for any inappropriate limitations in the scope of work. This is a huge red flag here. Neon is insisting on limiting the audit scope for overseas subsidiaries and refusing to disclose related party transactions. In the auditing world, a limitation on scope is often a sign that the client is hiding something. Sixth, look for indications of money laundering or criminal activities. The market rumors regarding investigations into foreign currency transactions strongly suggest that the firm needs to be cautious about the legality of the funds. And finally, evaluate the reasons for the appointment of the new firm and the non-reappointment of the previous one. The previous auditor resigned abruptly due to disagreements. This is a classic indicator of a toxic relationship between the auditor and management.
To wrap up your answer, add a concluding note stating that while the firm's knowledge of a client's integrity grows over time through an ongoing relationship, the initial red flags in this case are too significant to ignore. Keep this structure in mind. Identify the principle, link it to the fact in the case, and conclude. You've got this.
All right, let's dive into this important scenario. Imagine you are in the shoes of CA Mercury, who has prepared a draft audit report for the financial statements of Mars. Now, here is the twist. These financial statements aren't prepared using general accounting standards, but are instead based on the specific financial reporting provisions of a contract with Venus. CA Mercury has decided to give an unmodified opinion, but she has also included a draw attention note, specifically Note A, which explains the basis of accounting. The core challenge here is, how does she ensure that this report isn't misused by people who aren't part of this specific contract?
To answer this in your exam, you need to follow a two-part structure. First, explain the strategy, and second, provide the exact draft paragraph. Starting with the strategy, CA Mercury should indicate that the auditor's report is intended solely for specific users. Depending on the applicable laws or regulations, she can achieve this by restricting the distribution or the use of the report. In such cases, the paragraph alerting the readers should be expanded to include these restrictions, and the heading should be modified to reflect this.
Now let's look at the exact wording for the draft paragraph. This is where you score your marks, so pay close attention to the phrasing. The heading should be Basis of Accounting and Restriction on Distribution and Use, with emphasis of matter in brackets. The body of the paragraph should read as follows. Without modifying our opinion, we draw attention to Note A to the financial statements, which describes the basis of accounting. The financial statements are prepared to assist the company to comply with the financial reporting provisions of the contract referred to above. As a result, the financial statements may not be suitable for another purpose. Our report is intended solely for Mars and Venus and should not be distributed to or used by parties other than Mars and Venus.
All right, everyone, let's dive deep into this critical case study. This is a classic exam scenario where professional ethics and quality control are pitted against commercial pressure. The managing partner is pushing them to just use standard procedures to meet the deadline.
Part 1. The Theoretical Framework of SQC1. You must mention that under SQC1, which deals with quality control for firms, the engagement partner must evaluate if the firm has the capabilities, competence, time, and resources to handle the job. And finally, can the firm actually meet the reporting deadline?
Part 2, the application of SA 220. Now, move to SA 220, which focuses on quality control for a specific audit. Here, the responsibility of the engagement partner mirrors SQC1, compliance with ethical requirements and any significant issues that cropped up in previous audits.
Part 3. The analysis and conclusion. This is where you apply the law to the facts. In this case, Mars and Associates is clearly lacking the technical expertise for a highly regulated field like infrastructure finance. The withdrawal of the previous auditor is a massive warning sign that cannot be ignored. Proceeding under pressure from the managing partner without addressing these gaps would be a direct violation of both SQC 1 and SA 220.
So what is the final verdict? CA Mars must not proceed unless she is satisfied that all conditions are met. To uphold professional standards, she should take 3 specific actions. First, assess the firm's capability and consider hiring external experts. Second, investigate the exact reasons why the previous auditor withdrew. And third, ensure a qualified EQCR reviewer is appointed to review the work before the report is issued.
First, let's look at the scenario. We have a company, let's call it Mars Limited, which manufactures medicines. Now, because they deal with complex chemicals, the physical verification of stock isn't something a regular auditor can do alone. It requires an expert. In this case, both the management and the auditor engaged their own experts. However, the auditor found that the work performed by their expert was not adequate. Even after trying additional procedures and further work, the auditor still couldn't get the evidence they needed. Now, here is where the auditor made a critical mistake. Instead of modifying the opinion due to a lack of sufficient appropriate audit evidence, the auditor issued a clean report but mentioned the expert's name in the report, thinking this would reduce their own responsibility.
According to SA 620, if an auditor concludes that the expert's work is inadequate and the matter cannot be resolved through additional procedures, which could include engaging another expert, it may be necessary to express a modified opinion under SA 705. This is because the auditor has not obtained sufficient appropriate audit evidence.
Next, address the point about referring to the expert in the report. This is a very important rule. The auditor shall not refer to the work of an auditor's expert in a report containing an unmodified or clean opinion, unless it is specifically required by law or regulation. Even if the law requires such a reference, the auditor must clearly state that this reference does not reduce the auditor's responsibility for the opinion.
Now, what if the opinion is modified? If the auditor refers to the expert because it helps the reader understand why the opinion was modified, they still must state that this reference does not reduce their responsibility. Also, in such a case, the auditor might need the expert's permission before making the reference.
Finally, let's apply this to Mars Limited. In this case, the auditor's action of issuing a clean report while mentioning the expert to shift responsibility is completely wrong. The auditor should have issued a modified report. Even if they referred to the expert to explain that modification, they must explicitly state that the responsibility for the audit opinion remains solely with the auditor. Remember, students, the core takeaway here is, you can never use an expert's name as a shield to reduce your professional responsibility.
First, let's look at the core legal provision. We refer to Clause 7 of Part 1 of the first schedule to the Chartered Accountants Act, 1949. This clause is very strict. It basically restrains a chartered accountant in practice from advertising their professional attainments or services. More importantly, it prohibits a member from using any designation or expression other than chartered accountant on their professional documents, visiting cards, letterheads, or signboards.
Now, there are a few exceptions here. You can use a degree from a recognized university, or a title indicating membership of the institute or any other institution recognized by the central government or the council. Now, here is the critical nuance you must remember for the exam. When a chartered accountant is acting as an advisor or consultant to a capital issue, their name and address can be mentioned in the client company's offered documents and advertisements under the caption advisor or consultant to the issue. That is perfectly fine because it's the client's document. However, the golden rule is this. The member must not use the designations merchant banker or advisor to the issue on their own personal professional documents, such as their own letterheads or visiting cards.
Now let's apply this to our specific case. Here we have Neon, a chartered accountant who has registered as a Category 4 merchant banker and acted as an advisor for the capital issue of Mars Limited. Element Neon did two things. First, he used the caption merchant banker in the client's offer documents. Second, he used the term advisor to issue on his own letterheads, visiting cards, and professional documents. While the first part might be acceptable in the client's document, the second part is a clear violation. By putting advisor to issue on his own visiting cards and letterheads, he has breached the code of ethics. Therefore, the conclusion is clear. Neon shall be held guilty of professional misconduct under Clause 7 of Part 1 of the first schedule to the Chartered Accountants Act, 1949.
All right, let's dive deep into this case study. Imagine you are an independent practitioner tasked with a compilation engagement for Mars Solutions, Private Limited under SRS 4410.
This is a classic exam scenario where you're preparing consolidated financial statements for a merger, but you've hit a wall with missing documents, aggressive estimates, and undisclosed liabilities. Now, when you write this in your exam, you must maintain a very specific structure to score full marks.
First, the fundamental rule. The practitioner shall compile the financial information using the records, documents, and significant judgments provided by management. In our case with Mars Solutions, this means you start with the electronic and physical records they gave you, including those judgments on revenue and asset classification. Second, you cannot just blindly accept these figures. The practitioner shall discuss significant judgments with management or those charged with governance. This is crucial here because we have conflicting views on doubtful debts and depreciation lives. You must engage in a dialogue with the leadership to understand the basis of these estimates.
Third, before you wrap things up, there is a mandatory quality check. Prior to completion, the practitioner shall read the compiled financial information. This is where you'd spot those discrepancies in inventory or the missing fixed asset documents we see in the scenario. Fourth, what happens when things are wrong? If the records, documents, or significant judgments provided by management are found to be incomplete or inaccurate, the practitioner shall request additional or corrected information. This is your professional duty. You don't just ignore the undisclosed liabilities or the incomplete related party transactions. You formally ask management to fix them.
Finally, we come to the critical exit clause. If the practitioner is unable to complete the engagement because management fails to provide the requested or corrected information, the practitioner shall withdraw from the engagement and inform management of the reasons for the withdrawal. In the case of Mars Solutions, since management is unable to provide corrected documentation for material items despite repeated requests, your final professional action is to withdraw and clearly communicate why you are doing so.
Keep this five-step flow in your mind. Compile, discuss, read, request, and if all else fails, withdraw. Follow this sequence in your answer and you'll nail this question.
All right, let's dive into this important case study regarding the sharing of professional fees. This is a classic exam question that tests your understanding of the first schedule of the Chartered Accountants Act, 1949. First, let's look at the scenario. We have Ms. Venus, a practicing chartered accountant, and Mr. Mars, who is a practicing advocate. They've formed a mutually beneficial arrangement where Ms. Venus refers tax litigation cases to Mr. Mars, and Mr. Mars consults Ms. Venus for financial matters. The critical point here is that they have started sharing a portion of the profits from their professional work. The question is, does this violate the code of professional ethics?
According to Clause 2 of Part 1 of the first schedule to the Chartered Accountants Act, 1949, a chartered accountant in practice is deemed guilty of professional misconduct if they pay, or agree to pay, any share, commission, or brokerage of their professional fees to any person who is not a member of the Institute. But wait, there's a second side to this. Clause 3 of Part 1 of the first schedule also states that a chartered accountant is guilty of misconduct if they accept any part of the profits of professional work from a person who is not a member of the Institute.
Now, if you stop here, you might think Ms. Venus is in trouble. But this is where the exception comes in, and this is the key to scoring full marks. You must mention that a practicing member can share fees or profits with members of other professional bodies or persons with qualifications prescribed by the Council under Regulation 53A of the Chartered Accountants Regulations, 1988. Crucially, the members of the Bar Council of India are specifically included under this regulation.
So applying this to our case, since Mr. Mars is an advocate and a member of the Bar Council, he is a recognized professional under Regulation 53A therefore. Sharing profits between Ms. Venus and Mr. Mars is perfectly legal. To conclude your answer, clearly state that Ms. Venus, the practicing chartered accountant, will not be held guilty of professional misconduct under the aforementioned clauses for paying or accepting a part of the profits from Mr. Mars. Keep this structure in mind. First the general rule, then the specific prohibition, then the regulatory exception, and finally the conclusion.
All right, everyone, let's dive into this critical case study. Imagine we are looking at a high-stakes scenario involving a company we will call Mars. Mars is in the business of manufacturing advanced aircraft and is currently in a transition phase, moving from old technology to the new Tejas model. Now, the company wants to raise funds through private equity, and instead of a full-blown statutory audit, they've asked us for a review engagement for the year ended March 31st, 2025. As an aspiring CA, you need to be very careful here. A review engagement is not an audit. It provides limited assurance. Before you sign that engagement letter, you must evaluate specific factors based on the Standard on Review Engagements, or SRE 2400.
First, let's look at the acceptability of the financial reporting framework. You need to ask yourself, is the framework used to prepare these statements appropriate? In this case, Mars is using IND AS. You must ensure that this framework is acceptable given the nature of the entity and the purpose of the financial statements. If these were special purpose statements, you would also need to understand exactly who the intended users are and why they need them.
Second, and this is absolutely vital for your exam answers, you must focus on management's acknowledgement of responsibilities. You cannot just take the CFO's word for it. You need a written agreement. There are 3 pillars to this acknowledgement that you must list in your answer. 1. Management must acknowledge their responsibility for the preparation of the financial statements. This includes ensuring they are in accordance with the applicable framework and that they present a fair view. 2. They must take ownership of establishing internal controls. Even though the management at Mars mentioned that their controls are informal and undocumented due to rapid expansion and geopolitical tensions, they must still acknowledge that it is their job to ensure the statements are free from material misstatement, whether caused by fraud or error.
And 3, you need a guarantee of full access and information. This means they must agree to provide all relevant records and documentation, any additional information you request, and most importantly, unrestricted access to people within the organization so you can gather your evidence.
Now, here is your concluding punchline for the examiner. If these conditions are not met, if management hesitates to sign these acknowledgements, or if the framework is inappropriate, then, as per SRE 2400, you simply should not accept the engagement. Keep this structure in mind. Framework first, then the 3-pronged written agreement from management, and finally the conclusion. This is exactly how you score full marks.
All right, everyone, let's dive into this critical case study. Imagine we are dealing with a massive edtech giant, let's call it Mars. Now, Mars is under heavy fire from regulators like the Space Council and the Galactic Ministry because of delayed financial reports and governance issues. The external auditors, let's call them Neon, are feeling the heat. Due to extreme time pressure, Neon decides to use the internal audit team of Mars to get direct assistance in verifying revenue from subscriptions and student data. However, when the regulators reviewed the files, they found a major gap. The documentation didn't say anything about the work done by the internal auditors.
First, you must document the evaluation of the existence and significance of threats to the objectivity of the internal auditors. You also need to record the level of competence of those internal auditors. Basically, you are proving that the people helping you are actually qualified and unbiased. Second, you must record the basis for the decision regarding the nature and extent of the work performed by the internal auditors. Why did you give them this specific task and not another? That reasoning must be on paper.
Third, you need to document who reviewed the work, the date of that review, and the extent of the review. This must be done in accordance with standard on Auditing 230, which deals with audit documentation. Remember, you cannot just take their word for it. You must review it and document that review. Fourth, you must include the written agreements obtained from both the internal auditors and an authorized representative of the entity. This ensures everyone is on the same page regarding their roles.
And fifth, you must include the actual working papers prepared by the internal auditors who provided that direct assistance. To wrap up your answer and add that extra professional touch, mention that in India, the law now recognizes that internal audit is essential for the efficient running of companies. Therefore, reviewing the internal audit function in specified companies has become a statutory responsibility for the statutory auditor. Keep this structure in mind: evaluation, basis, review, agreements, and working papers. Master these 5 points, and you'll nail this topic.
All right, everyone, let's dive deep into this case study. This is a classic scenario where we need to apply the national guidelines on responsible business conduct, specifically focusing on how a company delivers value to its consumers.
In this case, we have a company, let's call it Mars, which is claiming its software is 100% Swadeshi and sustainable. But when we look at the facts, there are some serious red flags: non-recyclable plastic packaging, misleading claims about imports, lack of privacy policies, no grievance system, and unfair competition tactics.
Now, for your exam, you must structure your answer exactly as follows to score maximum marks. Start by identifying the relevant principle. Here, we are talking about Principle 9, which is provide value to the consumers in a responsible manner. You should state that the primary purpose of any business is to create or provide useful products and services to the customer in exchange for reasonable profits.
First, entities must work to reduce the negative impacts of their products on consumers, the natural environment, and society at large. In our case, Mars failed here by using non-recyclable plastic. Second, when designing and marketing products, the organization should not prevent freedom of choice or fair competition. This directly hits the point about Mars claiming to be the only certified brand without any actual certification. Third, there must be transparent and accurate disclosure of all adverse impacts to the user, the planet, society, and biodiversity. Fourth, this is a big one for the digital age. When handling customer data, the right to privacy of the customer must be strictly maintained. Mars ignored this by collecting data without a privacy policy.
Fifth, companies must inform customers about safe and responsible usage, reuse, recycling, and disposal of products to eliminate overconsumption. Again, the lack of disposal instructions on the pen drives is a clear violation here. Sixth, when advertising, organizations must ensure that misleading or confusing information is not given to customers. This applies to the claim of nothing being imported when foreign companies were actually in the credit list. Seventh, business enterprises should provide a transparent and accessible grievance redressal and feedback management system. Mars failed this by leaving customer complaints unresolved. And finally, for those providing essential goods or utilities, they must enable universal access in a non-discriminatory and responsible manner.
If you present your answer by linking these core elements to the facts of the case, you will demonstrate a professional level of analysis. Keep this structure in mind, stay confident, and you'll nail this topic.
All right, everyone, let's dive into this important case study on professional misconduct. This is a classic exam-style question, and I want you to pay close attention to how we structure the answer to score maximum marks. First, let's look at the scenario. We have CA Mars, a first-class chartered accountant who has just joined a firm on April 1, 2025. Now, here is the core issue, despite multiple reminders from the ICAI-CA. Mars has failed to respond with her appointment date and has not submitted her membership certificate. The question asks us to comment on this based on the provisions of the Chartered Accountants Act, 1949. When you write this in your exam, I want you to follow this exact two-step structure, the provision and the conclusion.
Starting with the provision, you must quote the specific clause. In accordance with Clause 2 of Part 3 of the First Schedule to the Chartered Accountants Act, 1949, a member, whether they are in practice or not, is considered to be engaged in professional misconduct if they fail to provide information requested or do not comply with the requirements set forth by the Institute, the Council, or any of its committees. This includes the Director of Discipline, the Board of Discipline, the Disciplinary Committee, the Quality Review Board, or the Appellate Authority.
Now let's move to the conclusion, where we apply that law to our specific facts. Therefore, in this given scenario, CA Mars has neglected to respond to the Institute's letters seeking confirmation of her appointment date and has not submitted her membership certificate. Consequently, she is deemed to be guilty of professional misconduct, as per Clause 2 of Part 3 of the First Schedule to the Chartered Accountants Act, 1949. Remember, the key here is that the rule applies regardless of whether the member is in practice or in employment. Just keep that structure, provision followed by conclusion, and you'll nail this question. Keep pushing forward, you've got this.
All right, let's dive into this critical audit scenario. Imagine we are analyzing the statutory audit of Mars Limited, which is a non-banking financial company focusing on housing finance. Now, here is the core problem. Mars Limited has a massive amount of non-convertible debentures worth 2,150 crores. They've hit a liquidity crunch and missed interest payments of 15 crores. Because of this, rating agencies have slashed their credit rating from A4 all the way down to D in the world of finance. A D rating is a huge red flag. It means the company is in default or very likely to be.
As the auditor, Neon needs to be extremely vigilant about how the company handles its public deposits following this downgrade. When you write this in your exam, I want you to structure your answer into two main pillars. First, Neon must verify the link between the credit rating and the quantum of deposits. You see, the ceiling on how much a company can accept as public deposits is directly linked to its credit rating from an approved agency. If a rating is upgraded or downgraded, the company must increase or reduce its deposits to match that new rating within a specific timeframe. Most importantly, Neon must ensure that Mars Limited has informed the RBI about this change in writing.
Second, we move to the critical regularization process. When a credit rating drops below the minimum specified investment grade, the NBFC cannot just carry on as usual. There are 4 strict steps Neon must check for. 1. The company must immediately stop accepting any fresh public deposits and must stop renewing existing ones. 2. All current deposits must be allowed to run off to their natural maturity.
3. The company must report this entire position to the concerned regional office of the RBI where they are registered, and this must be done within 15 working days. And 4. No matured public deposit can be renewed unless the depositor gives their express and voluntary consent. Keep this structure in mind. First, the general link between rating and deposit limits, and second, the specific emergency actions required during a downgrade.
All right, let's dive into this important case study on fraud reporting. This is a classic exam favorite, so pay close attention to the structure, because that is exactly how you should present it in your answer sheet to score full marks. First, let's look at the scenario. We have an auditor, let's call him CA Mercury, who is auditing a company called Mars. During the audit, CA Mercury discovers a fraud involving 75 lakh rupees committed by the employees. The core question here is whether he is legally required to report this to the central government via the MCA portal.
To answer this, we start with the legal framework. You must mention Section 143, subsection 12 of the Companies Act, 2013, read with Rule 13 of the Companies Audit and Auditors Rules, 2014. According to these provisions, an auditor is mandated to report a fraud to the central government only if the amount involved, or expected to be involved, is 1 crore rupees or more.
Now, let's apply this law to our specific case. In the case of Mars, the fraud amount is 75 lakhs. Since 75 lakhs is clearly less than the threshold of 1 crore, CA Mercury is under no statutory obligation to report this matter to the central government using Form ADT-4 on the MCA portal.
But wait, that doesn't mean the auditor can just ignore it. This is where students often lose marks. You must explain the alternative procedure. When the fraud amount is less than 1 crore, the auditor must report the matter to the audit committee constituted under Section 177, or if there is no such committee, they must report it to the board of directors.
To wrap up your answer and show the examiner you have a comprehensive grip on the subject, add one final point. Mention that regardless of the amount, the auditor still has a professional obligation to report matters pertaining to fraud under Clause 11 of Paragraph 3 of the CARO 2020. So, to recap the flow for your exam, start with the legal section and the 1 crore threshold. Apply it to the 75 lakh figure to conclude no government reporting is needed. Explain the reporting to the board or audit committee, and finish with the CARO 2020 requirement.
Imagine a scenario where a student, let's call him Mars, approaches a practicing chartered accountant, Planet Jupiter, for articleship. Now Planet Jupiter offers a stipend of 2,000 rupees per month, but there is a catch. He proposes to pay this stipend every 6 months instead of monthly. To make this sound attractive, he offers 10% interest compounded monthly to compensate for the delay, claiming that his professional receipts from clients only come in every 6 months. Mars agrees to this, hoping to earn extra money through interest. However, there is a key detail here. Planet Jupiter actually pays all his other employees on time.
First, you must start with the general provision. State clearly that a member of the institute, whether in practice or not, shall be deemed guilty of professional misconduct under Clause 1 of Part 2 of the Second Schedule to the Chartered Accountants Act, 1949, if he contravenes any of the provisions of this act, the regulations made under it, or any guidelines issued by the Council. This is your foundation.
Next, apply this to the facts of the case. In this situation, Planet Jupiter has failed to make the stipend payments to the articled assistant every month, which is a direct violation of Regulation 48. Now, here is where students often get confused, so listen carefully. The fact that the assistant is being compensated with extra interest is completely irrelevant. Furthermore, the excuse that client receipts happen every 6 months is not acceptable, especially since Planet Jupiter is paying his other employees on time. This proves that the delay was a choice, not a necessity.
To conclude your answer, bring it all together. Therefore, Planet Jupiter is guilty of professional misconduct under Clause 1 of Part 2 of the Second Schedule to the Chartered Accountants Act, 1949, because he has contravened Regulation 48 by not making the stipend payments on a monthly basis. Keep this structure in mind: provision, application, and conclusion. You've got this.
Neptune Limited has investments that dropped in value. In the previous year, ending March 31st, 2023, the auditor issued a qualified opinion because the company refused to provide 70 lakh rupees for this diminution. Now, we are in the 2023-24 audit, and the company still hasn't made that provision. The matter remains unresolved.
To answer this, you must start with the technical foundation. Refer to Standard on Auditing 710, which deals with comparative information, specifically corresponding figures and comparative financial statements. The core principle here is simple. If the prior period's report was qualified and that specific issue is still not resolved, the auditor cannot simply ignore it. You must modify the opinion on the current period's financial statements.
Now, here is the part where students often lose marks. You need to explain how to handle the basis for modification paragraph. There are two distinct paths depending on the materiality. Path 1. If the effects of this unresolved matter are material to the current period's figures, the auditor must refer to both the current period's figures and the corresponding figures in the description of the matter. Path 2. In all other cases, the auditor should explain that the opinion is modified because the unresolved matter affects the comparability between the current period's figures and the corresponding figures.
To wrap this up and conclude your answer for the examiner, apply this to the case. For Neptune Limited, since the provision of 70 lakh rupees is still missing, the auditor must modify the report for both the current and previous year's figures, following the guidelines we just discussed. Keep this structure in mind. State the standard, explain the general rule, detail the two options for the modification paragraph, and then apply it directly to Neptune Limited.
All right, let's dive into this important conceptual question regarding the auditor's reporting when a previous modification is resolved. This is a classic exam scenario, so pay close attention to how we structure the answer. First, let's look at the technical foundation. You must start your answer by citing Standard on Auditing 710. According to SA 710, we need to consider what happens when a prior period's audit report contained a qualified opinion.
The key rule here is that if the matter which caused that modified opinion has now been resolved, and it is properly accounted for or disclosed in the current financial statements according to the reporting framework, then the auditor's opinion for the current period does not need to refer back to that previous modification.
Now, let's apply this logic to our specific case. In the case of planet Neptune, if the company makes an adequate provision for the diminution in the year 2023-24, it means the issue from the previous year has been resolved and correctly accounted for. Therefore, the auditor is not required to refer to the earlier year's modification in the current report.
To score full marks, remember to keep this exact structure. First, state the general principle from SA 710 and then apply it directly to planet Neptune. It's a simple, logical flow that examiners love to see. You've got this.
All right, let's dive into this critical case study. Imagine you are the engagement partner for the audit of Neon Petrochemicals Limited for the financial year 2025-26. Here is the scenario. The company has expanded into a high-risk ecological zone. Now, the management is trying to tell you that because they have a general policy of being ethical, they don't need specific documented protocols for environmental law compliance. But as an auditor, you found three major red flags. First, there are no formal records of the environmental statutes for this new zone. Second, while there is a code of ethics on the website, the actual workers on the ground have never been briefed on it. And third, a whistleblower has alleged that waste disposal norms are being bypassed just to save costs.
The core question here is a general ethical policy sufficient? The answer is a resounding no. Under the relevant standards on auditing, a vague statement of ethics cannot replace a robust compliance framework. To score full marks in your exam, you must structure your answer by identifying the specific missing policies and procedures. Let's break down the framework that Neon Petrochemicals should have implemented.
First, the company must focus on monitoring legal requirements. They need to ensure that their operating procedures are specifically designed to meet these laws. This directly addresses the fact that they had no records for the new ecological zone. Second, they must institute and operate appropriate systems of internal control. You cannot rely on a handshake or a general feeling of ethics. You need hard controls. Third, it is not enough to just have a code of conduct on a website. They must develop, publicize, and actually follow that code. Fourth, and this is a key point for your answer, the company must ensure employees are properly trained. A code of conduct is useless if the factory workers don't understand it. This addresses the lapse where workers were never briefed.
Fifth, there must be a mechanism for monitoring compliance with that code and a clear process to discipline employees who fail to comply. Sixth, the company should engage professional legal advisors to help them stay on top of complex legal requirements. And finally, they must maintain a formal register of all significant laws and regulations applicable to their industry, along with a formal record of complaints. This is exactly how they should have handled the whistleblower allegations.
Now remember, these lapses are not just administrative errors. They impair the audit's integrity because they indicate a weak control environment, which significantly increases the risk of material misstatement and legal noncompliance. Keep this structure in mind. Identify the lapse, link it to the required procedure, and conclude with the impact on the audit. You've got this.
All right, everyone, let's dive into this critical case study involving Growth Limited, which we will refer to as Mars for our analysis. This is a classic scenario testing your ability to link two very important standards, SA 505 on external confirmations and SA 500 on audit evidence. Pay close attention to how we structure this answer, as this is exactly how you should present it in your exams to score maximum marks.
First, let's look at the facts. As the auditor of Mars, you sent positive confirmation requests to 45 creditors. Now, here is the red flag. Your articled clerk discovered that for 38 of these creditors, their GST registrations were canceled during the financial year. Even more concerning, there are no new registrations linked to their PANs. Yet despite these businesses seemingly being closed, you received responses to your confirmation requests within just 1 week. This is a massive contradiction.
Now, let's build the answer. Start your response by citing SA 505, External Confirmations. You must state that if an auditor determines that a response to a confirmation request is not reliable, they must evaluate the implications on the assessment of the relevant risks of material misstatement, including the risk of fraud. You also need to consider how this affects the nature, timing, and extent of other audit procedures.
In the context of Mars, explain that the cancellation of GSD registrations for 38 concerns strongly indicates that the businesses at those addresses were closed. Since the auditor sent requests in March 2024 and received responses despite the businesses being defunct, the reliability of these responses is now highly questionable. To strengthen your answer, bring in SA 500 audit evidence. Explain that even when evidence comes from external sources, certain circumstances can affect its reliability. Mention that all responses carry a risk of interception, alteration, or fraud, regardless of whether they are on paper or electronic. Specifically, highlight the factors that create doubt. In this case, there is a significant risk that the response did not actually come from the originally intended confirming party.
To conclude your answer, clearly state that these unreliable responses are a major fraud risk factor. As an auditor, you cannot simply ignore this. You must evaluate this risk and perform deeper investigative procedures to ensure the financial statements are not materially misstated. Keep this structure in mind. Start with the standard, apply it to the facts of Mars, support it with the reliability criteria from SA 500, and end with the conclusion regarding fraud risk.